hang out tonight. Hopefully you all had a chance to catch the sunset. It was absolutely gorgeous on the ride back to school today. And I want to introduce you all to Bill Smith. This is the second year with us. Let me tell you, you all are in for a treat. We loved him so much last year. We invited him back, and the school counseling department had the privilege of meeting with him this afternoon. He gave us some beautiful professional development. We are filming this program and this topic. There's so much information on it. You may not be able to catch everything, so you're always welcome. In about a week, it'll be on our school counseling website under video presentation. So we're welcome for you all to hop on at any time and then tell any of your friends that may not have been able to attend. Bill has done so much in the world of financial aid. He helped create the estimators known as net price calculator. He's wonderful at determining expected family contributions using both the FAFSA and the CSS profile. You'll hear about that today. He's co-authored a couple papers, and the list goes on and on and on. So enough of hearing from me, and Bill, thank you so much.
Great, thank you very much. Very nice. Might be premature though. see what you think at the end. So we're going to go through a lot of stuff tonight, and feel free to take notes or pictures. A lot of people do that, but I'm happy to email the slides to you, and they'll also be available on the website. My email is on one of the white handouts. And then we're also going to be covering a lot of material pretty quickly. So I'd encourage you to ask questions as we go along. Chances are other people have questions too, and it gives me a chance to get a sip of water too. So with that, let's dive in. So I like to start, it's going to be kind of a heavy topic. College is expensive. So I like to remind you about the end in mind, which is that college really does pay off. So on average, college graduates have about 46% less unemployment than high school graduates, and they make about 64% more. So that's hopefully the payoff for all of your sons and daughters. So what we're going to be talking about tonight is two big things. The first one is assessing where you might get financial aid. And you, of course, really means your students, but it's a family affair, so I say you, it's you collectively most of the time. And then we'll also talk about deciding what you can afford, because that's a big part of it too, and it's a big number, and a lot of people have kind of a tough time thinking through big numbers and what to do with them. So I'll show you a way to approach that. So assessing where you might get aid is really a question of identifying your student's profile in terms of eligibility for need-based aid and merit-based aid, and then identifying colleges whose awarding patterns match your student's profile. So when you have that kind of meshing, that's when you have the better likelihood of getting financial aid. And we'll talk about that concept as we go through. So we're going to talk a lot about grants and scholarships, how they're determined, and how to identify colleges that might award either need or merit-based aid depending on what your student's profile is. Deciding what you can afford means focusing on the true cost of college. And there are all kinds of numbers that float around. I'll show you some examples of them. And what you really care about is what's called the net price. And every individual student and family's net price is different and unique to you. So we'll talk about that a lot. We'll talk about thinking about what resources are available to pay for college. For a lot of people, the resources may not be enough, so it means that there might be some borrowing involved. We'll talk about how to estimate how much you might need to borrow and how to think about whether what you're talking about borrowing is reasonable and a good idea. So that's what we're going to do. All right, so the net price is the true cost of college. when most people think about the cost of college, they are talking about kind of the top line, the sticker price, which ranges from about $31,000 at UConn up to about $72,000 at NYU. That's for 1 year. And that's for everything, tuition and fees, room and board, and so on. But it turns out that colleges award a lot of gift aid that helps to reduce the cost of college. And you can see that the average gift aid ranges from about $11,000 at UConn to over $30,000 at some of those other schools, which means that the net price for aided students, and that's kind of a tricky concept there, ranges from about $20 up to $40. However, it turns out that not all students are aided. So what that means is that at UConn, about 59% of students receive gift aid. That means about 41% are paying the full sticker price. At NYU, 43% of students are receiving gift aid. 57% of those students are paying that full sticker price, $72,000 a year. So when you factor that into the equation, the true net price on average for all students attending these schools ranges from $24,000 at UConn to as much as $58,000 for a year at NYU. So all of these numbers are kind of confusing. I put them up there to remind you that when you see something on the internet that says these are the 10 best value colleges, that really is meaningless because it doesn't necessarily mean the best value for whatever profile your student has in terms of eligibility for need and merit-based aid. So we'll talk about how you can kind of ignore those and find your true cost. So it doesn't matter what colleges charge. What really matters is what you're going to pay, and what you're going to pay is the net price. That's the sticker price minus gift aid. Okay, so keep that in mind as we're going through this evening. So there are different types of financial aid, and there are two major categories. The first one is gift aid. This is free money, and it's usually called either grants if it's based on financial need, or scholarships if it's based on the student's academic background, things like grades and test scores. This is free money, you don't have to pay it back, and it truly reduces the cost of college. The other type of financial aid is called self-help, and this is work study, a job that a student might have during the college years, or loans, money that you borrow to pay for college. So when you look at it like this, it's pretty clear, it's pretty obvious that gift aid is better than self-help, right? That makes total sense. But when the colleges talk about it, they don't necessarily make it as clear to you as it ought to be. So this is an example of how a college tells people about how much financial aid they're going to get. And you can tell that it was not designed by the marketing department, and it was not designed by people whose goal was to make it as clear as possible. So if you look at this award letter, it looks like there's $22,000 of financial aid, which sounds good. $22,000 is a lot of money. But when you break it down, it turns out that of the 7 line items on this award letter, 4 of them are gift aid, 2 of them are loans, and then 1 of them is work study. So what you really need to do when you get something like this is to break it down so that you know what type of aid is what. So I did that, and I added up the gift aid, and it turns out to be about $15,000. The loans are $5,500, and the work study is $1,800. Okay, so $15,000 is still a lot of money, but it's not nearly as good as $22,000. So starting to look not so good. But this is missing some important information. It's really not enough to tell you $1 off. You've got to know what the starting price is to know what you're really going to pay. So what's missing is the list price and your true cost, which is the net price after you do the arithmetic. So I went online and I looked up what the starting price was for this college. And when you add up tuition and fees, room and board, and so on, the starting price for this college is about $50,000 for a year. When you subtract the $15,000 in gift aid, that means that the net price for 1 year of this college is about $35,000. Okay? So keep this in mind. We're going to come back to this at the end. But for now, just keep that concept in mind that the net price is what you really want to focus on, and you need to be sure to distinguish between gift aid and what's not gift aid. Does room and board include what? Yes, room and board includes a meal plan, and it includes living in the dorm. So that's the living expenses for 9 months at this college. All right, so let's talk about gift aid in a little bit more detail. So we said that there are two types. One of them is need-based aid. That's typically called grants. So if you see the word grants, they're probably referring to need-based aid more often than not. That's based on family income and assets, and you apply for gift aid using the FAFSA. The FAFSA is required for financial aid at just about every U.S. college. Every U.S. college that participates in federal financial aid programs, which is 99.9% of them, requires the FAFSA in order to apply for financial aid. In addition to the FAFSA, about 150 colleges require a second aid application, which is called the CSS profile. Now, there are over 2,500 four-year colleges in the United States. Only about 150 of them require the profile, but they tend to be the colleges that you are most likely to have heard of. They're the most famous colleges, and they tend to be the colleges that are most generous with need-based financial aid. So there's a good chance that you will encounter the profile as you're going through the financial aid process. The other type of gift aid is merit-based aid, and that's typically called scholarships. And this is usually based on a student's grades, test scores, sometimes class rank, sometimes other factors will go into it. And often this is awarded without any additional application. So when the student sends in his or her application for admission to the college, often they will look at that and then they will get back in touch with the student and say, congratulations, you've been admitted, and we plan to offer you a scholarship of X to come to our college. So that's often, very commonly, the way you get academic scholarships or merit aid. However, it's not always the case. So you always want to go to a college's website, go to the websites of every college that your student is applying to, and make sure you read the financial aid pages so that you understand what you have to do in order to qualify for as much financial aid from all different sources as possible. All right, so let's talk first about the need-based aid. And this is what people probably traditionally think about as financial aid when they're talking about financial aid in general. So this is the algebra portion of the evening. COA minus EFC equals need, financial need. And that's a specific term in the college financial aid world. Financial need means your maximum potential eligibility for need-based aid. It doesn't mean how much you're going to get. It means the maximum that you could get. So let's break that down. Cost of attendance is composed of 4 elements. Tuition and fees, that's usually the biggest item. Room and board, that's living in the dorm and a meal plan. Plus allowances for books and supplies that the student is going to have to get in association with their classwork. and then transportation back and forth to campus and other miscellaneous expenses. So those 4 elements go into the cost of attendance. Cost of attendance then being that original sticker price. That's what we saw on that slide where it starts at $31,000 at UConn and $72,000 at NYU. EFC stands for Expected Family Contribution. And this is, I think, the most misleading term in the English language. Because if you read it in English, it makes it look like this is what you're going to pay for college. But it's rarely what people pay for college. And in fact, people usually pay more than the EFC, or often they pay more than the EFC, particularly if they are going to a school that awards only need-based aid. Okay? All the EFC really is a way of ranking every student who's applying to college compared to all of the other students in terms of the economic resources that the student and the family has available to pay for college. So it's important to remember we talked about identifying the student's profile in terms of eligibility for need-based aid. If you find that the EFC is lower than the cost of attendance, that means there's financial need. And if you want to find a college that meets that need, you want to find colleges whose awarding policy is to meet financial need. Okay? College aid policies vary. Some colleges meet 100% of need. Other colleges meet very little financial need. So if you've got high need, you ideally want to find a college that meets a large amount of need. If you are interested, you can go to this website and you can estimate what your EFC is. And knowing your EFC is helpful, but it's not sufficient. So what do I mean by that? Let's say that you go online to this estimator and you find out that your EFC is $40,000. What that means is that you will not qualify for a nickel of need-based aid at UConn because UConn's cost at $31,000 is less than the EFC, so there's no financial need. On the other hand, at NYU, where the cost is $72,000, you might be eligible for as much as $32,000 in potential need-based aid. I can tell you you will not get that much at NYU probably, but that's the maximum that you can get. So another way that knowing your EFC is helpful is if you go and you figure that your EFC is $40,000, multiply that by 4 times 4 years of college, that's $160,000, and then add, because most colleges don't meet full need, so add another $10,000 a year, you're up to $200,000. So if you do not have $200,000 available to pay for college, need-based aid may not be the solution to your college problem or paying for college. Merit-based aid might be another way that you want to explore looking at how you're going to pay for college. But that's another way that understanding what your EFC is can be helpful as you're thinking about how you're going to pay for college. Does that make sense? Okay. Another thing to keep in mind is that every college defines its own idea of what financial need is. So it may vary from one college to the other. And the other thing that you're going to find is that the college's idea of need is hardly ever the same as yours. Okay, so we said that there are 2 financial aid forms that you may need to fill out in order to apply for need-based aid. One of them is the FAFSA, one of them is the profile. And each form is associated with a formula, slightly different formula for calculating the EFC. So if you fill in both of those forms, you're going to end up with 2 different EFCs. But they all use the same basic approach, which is to look at income and assets of the parents and the students. So there are actually 4 separate calculations going on in the background when the EFC is calculated. And that can be important in terms of what your final cost is going to be, and I'll show you an example of that in a minute. A lot of people, when they start talking about financial aid, say, oh gosh, my assets are going to kill me for financial aid. Well, in reality, for most people, income plays a much bigger role in determining what the EFC is than assets do. And here's why. Once the formula gets to the amount of income that's going to be assessed in determining what the EFC is, they use a sliding scale of rates to decide what the EFC is. And those rates go up to about 47%. So once you reach a threshold, out of each dollar, about 50 cents is going to the EFC. On the other hand, assets have a maximum assessment rate of a little over 5%. So each additional dollar of assets is contributing about 5.5 cents to the EFC. So for most people, income plays a bigger role than assets do in determining what the EFC is. And let's stop for a second and just keep in mind, if you want to get need-based financial aid, lower EFC is better. Lower EFC means more eligibility for financial aid. So let's go into a little bit more detail about what goes into these. Yes? Yeah, so the question is, how do schools take into account income when the parents are divorced? That's a great question, and I'm going to talk about it specifically in a couple of minutes, so if I don't answer your question, make sure you let me know. So let's talk about how the parent contribution from income is calculated. So this is one of those 4 calculations that's going on in the background. And we'll start with the FAFSA. So the FAFSA starts with adjusted gross income. It used to be really easy. I could always say, oh, that's the bottom line of page 1 of your 1040. Now it's line 7 of your 1040. But adjusted gross income is the key starting number in determining what the EFC is. Then they add certain items of what's called untaxed income. So items that the IRS does not necessarily figure into your tax bill, but which colleges are going to consider when they're deciding how much financial aid you might be eligible for. The most common types of untaxed income are tax-deductible contributions that you make during the year to a retirement account. So if you take a tax deduction for an IRA contribution, or if you have 401k savings taken out of your pay before taxes, that amount of money is going to be added back to your income when they're figuring out how much the EFC is going to be. Another common type of untaxed income is child support received. So this is an example of a divorce situation. So the person or the ex-spouse who is receiving child support adds that to his or her income. The ex-spouse who is paying child support can deduct it from his or her income, or they're actually not going to deduct it. The formulas are going to do it for you, but it's going to be reported and calculated that way. After adding AGI and untaxed income, the formulas are going to subtract a very minimal amount of allowances for basic living expenses. And believe me, these are minimal living expenses, so it's not a whole lot. Whatever is left over after they add that up and subtract the allowances is called available income, and that is what's going to be assessed at gradually increasing rates, the maximum of which is about 47%. And that kicks in when you get about $34,000 of available income. Okay? So that's how the FAFSA parent contribution from income is calculated. The profile is very similar. It counts everything that the FAFSA does, plus it counts some additional items of untaxed income. And one of the most common ones is losses that might have been allowed on your tax form if you're a small business owner, if you have a Schedule C business, if you have a 1120S business, those losses will be added back as untaxed income. In addition, depreciation that might have been allowable for your business to reduce the amount of income that you report will also be added back. They'll also add things like untaxed Social Security. That's not counted on the FAFSA, but it is added back on the profile EFC calculation. They will, again, subtract some minimal allowances and then assess whatever is left over in a fashion similar to how the FAFSA does. So that's the concept of how the parent contribution from income is calculated. So the question is whether the deduction for taxes paid is state specific. So there are actually 3 types of taxes that are allowed on both of the forms. Federal income tax, which is the actual amount of federal income tax from line 13 of your 1040 in most cases. In addition, they'll do FICA taxes, so Social Security and Medicare, and then they will have an allowance for state and local taxes. And this is where it's intended to replicate to some extent the varying tax rates in different states. So I live in Maine. The allowance for state taxes in Maine on the FAFSA and the profile is less than it is for the allowance in Connecticut. But you'll find that it's probably not really compensating for the total amount of taxes that you pay in Connecticut. So if you're in a high tax state, you get a little bit more of a break on the FAFSA and the profile, but it probably isn't going to make a huge, huge difference. So the question is whether that allowance is meant to cover property taxes. It's intended, in theory, to cover all of the taxes you might pay. So sales tax, income tax, property taxes. So that's why it varies from one state to another, but it's an imperfect allowance. Okay, so let's talk about the parent contribution from assets. And we'll do it the same way. We'll talk about the FAFSA first and then the profile. So for the FAFSA, they're going to start with cash, savings, and checking. They're going to add investments, which would include things like mutual funds, brokerage accounts, and so on. It also includes real estate that you own that is not your primary residence. So if you own a second home, if you own income property, that's going to be considered an investment on the FAFSA. And then it will include things like trusts and 529 plans. They're going to subtract, again, a modest allowance for old age retirement. And this is really modest. In most cases, it's probably about $20,000 or so. And then they're going to assess whatever is left at a gradually increasing rate, the maximum of which is 5% for the profile and 5.64% for the FAFSA. Okay? Things that are not included as assets: personal property. So things that you own, your cars, if you have a boat, those are not included in the asset assessment. Retirement accounts are not included as assets, and whole life insurance is not included as an asset. Now, a minute ago, I said that the deductible portion of retirement savings that you make during the year counts as untaxed income. Here I'm saying that once the money is in the retirement account, that money is no longer assessed as an asset for financial aid purposes. So that can be a little bit tricky. Everyone make sense of that? So the theory, or the kind of the theory behind that is that during the college years, you have some discretion over whether you're saving for college or saving for retirement. But once the money actually gets into your retirement account, it is protected as an asset. The profile looks at everything that the FAFSA does, plus it adds some additional items. And the most important thing that the profile adds for most people is your primary residence. So the profile is going to be looking at home equity. What they're looking at is the value, which is the market value minus the amount of mortgage debt that you have securing it. So that's the definition of equity that they're looking at when they're adding home equity into the formula. So we'll talk about the timing, and the timing is a little tricky because they're looking at the income in the year that is 2 years before the college year. They're looking at assets as of the date that you're filing the form. So I'm going to give you a slide that will kind of show that to you, and you can refer back to it. The other thing that the profile is going to look at as assets that the FAFSA does not are assets in the siblings' names. So if you happen to set up accounts in all of your kids' names, the profile is going to look at those sibling assets as if they were owned by the parent. And then they will also consider the value of a small business. And then it's going to be assessed similarly to the FAFSA at a maximum rate of about 5%. Okay? So that's how the parent contribution from income and assets is calculated. They take those two elements, add them up, and that's called the total parent contribution. They're also looking at the student's income and assets. And then they're going to calculate what the student contribution is. Now, most high school students don't have all that much income, and the first $5,000 to $6,000 of student income doesn't make any difference on the financial aid forms. But if there's income above that, it's going to be assessed at about 50%. Student-owned assets are going to be assessed at 20 to 25%. So student-owned assets have a much bigger impact on the EFC than parent-owned assets, right? We said that parent-owned assets are assessed at a maximum of 5 to 5.64%. Student-owned assets are assessed at 20 to 25%. So that means if you've got $10,000 in the student's name, that's going to add $2,000 to $2,500 to the EFC. If you have that $10,000 in the parent's name, it's going to add about $500 to the EFC. Now here is a loophole if you happen to have money in the student's name, and this is a loophole that ordinary people can take advantage of potentially. So if you have assets in the student's name, if you convert those assets into a student-owned 529 account, there's a special exception, and student-owned 529 accounts are counted as a parent asset. So if you happen to have $10,000 in the student's name, if you liquidate it and then put it into a student-owned 529, that potentially can reduce the impact on the EFC. Now, anytime you're thinking about strategies like that to lower the EFC, keep in mind that it may or may not be helpful to you in terms of the total cost of college. Because if the student is not going to be getting need-based aid anyway, it won't make any difference. If the student is getting more merit-based aid than he or she would get in need-based aid, it makes no difference. So I have a lot of people who really go through all kinds of mental gymnastics, thinking about ways that they can lower their EFC. And a lot of times it really doesn't make sense. And the big rule of thumb to keep in mind is make sure that any moves that you make for financial aid planning are consistent with your best interests in terms of your long-term financial planning, okay? Yes.
There is an exception for pre-college tuition for siblings, but not other college expenses. With 3 kids who will be in college at the same time, like, is there anything, like, where would I explain to somebody that I cannot just give you, you cannot just compute everything and say, okay, so because then the first child will just clean out my bank account and then what?
Yeah.
And then I guess the other thing.
So this is the existential question of college planning. I mean, what you're saying essentially is if you are a middle-class family and you have these a relatively high EFC, the college is expecting you to pay a lot. How do you manage that, especially if you've got several kids in college? We'll talk about things that you can do that you might appeal to a college with, but remember that what they're doing is they're ranking students on the basis of the resources that they and their families have. If it turns out that need-based eligibility is going to be too expensive, what you can do is look at other ways to keep the cost of college manageable. One of them might be a state college, which starts with a lower cost. Another might be a college that awards merit aid, where the merit aid might be greater than the need-based aid. So the key to answering this question, which is really the big dilemma that millions of people are facing, is understanding your students' need and merit profiles and understanding how the colleges award aid. That's the answer to your question. Easier said than done, maybe, but that is the answer. Okay? All right. So there are some special cases in the EFC. And by the way, I always wonder when I do these things if I'm spending too much time, and I'll get to your question in a second, if I'm spending too much time talking about need-based aid, because for a lot of people, it really isn't going to be the answer to the college funding question. So we're going to spend a lot of time talking about alternatives to need-based aid, but everyone is interested in it, and you really have to understand whether you're going to be eligible or not. So I think it does make sense to talk about it still. Yes, ma'am.
Small businesses in real estate. If you own real estate in LLCs or partnerships, do they break it down between the percentage of how the members of the partnership or the LLCs own the real estate, or do they look at it as one lump sum, but there could be 4 members of that partnership that have kids all in college? Do you know?
So the question is, when you have real estate in an LLC or a partnership, and there are a lot of nuances to this question. So it turns out that business assets are partially shielded in the formula. So a lot of people say, okay, I'm going to say that my real estate investments are an LLC. That's probably not going to work unless you spend the majority of your working time managing your real estate business and you get the majority of your income from that real estate business. But your question had some other parts too. What if there are 4 people who are in partnership? Then the amount of the real estate is going to be your claim to it. So if you've got 4 people with equal shares, the total real estate value is $200,000. Your portion is $50,000. Okay. So some of these special cases in the EFC calculation. One of them is if you have multiple children in college at the same time, the parent portion of the EFC is going to be shared among those siblings. So if your family planning strategy was to have your kids bang, 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 that was a good financial aid strategy. Congratulations. Say that again.
Like they all have to be an undergrad?
So the question is, do they all have to be an undergrad? And that's another nuanced question. For the FAFSA, they all have to be undergrad. For the profile, for the FAFSA, undergraduate and graduate students count. For the profile, only undergraduate students count. Okay. So what's going to happen then is if you do have multiple children in college at the same time, this can be a big benefit. And sometimes people who think they might not qualify for need-based aid find that during the years in which they have 2 kids in college, or I even see sometimes where there are 3 kids in college at the same time, they do qualify for some need-based aid because of that. Another special circumstance, and this kind of gets to one of the questions that came up before, we said that the income that's being looked at on the financial aid forms is in the past. Well, what happens if something changes after the income year? So for students who are seniors in high school now and going to graduate in 2020 and start college in the fall of 2020, they're going to be looking at 2018 income. What if something bad happened after 2018? Someone lost a job, there was a death in the family, a divorce, or something like that. Colleges are going to be receptive to looking at what has happened. So you're going to report what actually took place in 2018, but then you send them a letter and you send it to each college that your student is applying to, and you say, I lost my job in 2019. My income in 2019 is less than what it was in 2018. Please consider me for additional financial aid. Okay. What if you win the lottery in 2019? Well, you got to pass. You don't have to tell them that your income goes up. So that's a good thing. But they're going to catch it in the student's sophomore year of college anyway. And then the final special case is divorced and separated parents. And here, the 2 forms have a very different approach. So the FAFSA is going to look at the custodial parent only, and if that parent has remarried, they will also look at the new spouse, okay? And custodial for financial aid purposes means something different than it does in a divorce decree. For financial aid purposes, it means the student or the parent with whom the student lived more than 50% of the time during the year that leads up to submitting the financial aid form. Okay, so the non-custodial parent is not going to be looked at for the FAFSA. On the other hand, the profile is going to look at both the custodial parent and the non-custodial parent, and if those parents have remarried, they will look at the new spouses too. So they are going to be looking at the income and assets of as many as 4 different people in figuring out what the profile EFC is. Now, they will do some calculations that are intended to put the primary burden on the biological parents, but those calculations are imperfect, and so it doesn't always work out to your advantage. Okay, does that help with your question about divorced parents?
If they have completely split the time of those children completely down the middle to the last second, how does the FAFSA form work?
So the question is, what if 2 divorced parents have shared 165 and a half days exactly of custody? In that case, they would look at the parent who provided greater than 50% of the financial support. So they have that first test is custody, the second test is financial support. Okay, so what we have been talking about so far is identifying your student's eligibility for need-based aid. Now we want to talk about if you determine that your student is likely to have eligibility for need-based aid, how can you find colleges that might meet that need? And this is a website that's maintained by the College Board, and it's got all kinds of data about college, including paying for college. And so at the University of Connecticut, they meet 58% of financial need on average, okay? But there is a second part to this. Out of the 58% of need that they meet, 55% of it is gift aid, grants and scholarships. 45% of it is loans and work study. So remember, this goes back to the idea of gift aid is good, loans and work study not as good. And you got to make sure that you're clear about what's involved. At NYU, they meet 65% of financial need on average, and about 76% of it is met with gift aid. At BU, they meet 91% of need on average, and 78% of that is met with gift aid. And at Colby College, they meet 100% of financial need as they define it, and they meet 92% of it with gift aid. So Colby is kind of the gold standard of meeting financial need with gift aid. So if you just multiply those numbers, you'll see what the average amount of financial need met with gift aid is. At Colby, 92% of the need is met with gift aid. At BU, 91% times 78% means 71% of need is met with gift aid. At NYU, 65 times 76 means 49% of need is met with gift aid. And at UConn, 58 times 55 means 32% of need is met with gift aid. Now, UConn is probably still going to be an affordable option for Connecticut residents, but that's because their starting cost is much lower for in-state residents than some of these other expensive colleges that we're talking about. But it's not necessarily because of their need-based aid. There are a lot of apps for this kind of stuff, and some of them are better than others. But it turns out to be a lot of manual work, unfortunately. Now, these are averages, right? So this can give you an idea of where to look if you are looking for colleges that might meet financial need. It doesn't necessarily mean how much you're going to get. And we're going to talk about how you figure out how much you're going to get. I'll give you a sneak preview. It's using net price calculators. So we'll talk about these net price calculators in a few minutes. All right, so there are quite a few myths surrounding financial aid, and one of them is the debt myth. So a lot of people say, well, I've got all of this debt. Surely that's going to factor into my financial aid calculation. The answer is probably not. Unsecured debt, which means all credit card debt and education debt, is never a factor in the EFC calculation. The only time home mortgage debt is a factor, or the only time debt is a factor, is when the asset that it secures is assessed for financial aid purposes. So that means that home mortgage debt is only a factor for the profile form. The FAFSA does not consider home equity, so they also don't consider the debt against the home. The profile does consider home equity, so the debt does reduce the value of the home that you report on the profile. Okay? The other debt is the savings, or the other myth is the savings myth. And the way this one goes is people get the idea that assets are going to be assessed as part of the financial aid formula. There's a kernel of truth to that. But they conclude that it doesn't make sense to save. And that is wrong, wrong, wrong. Okay? I have never seen a case where someone with savings is worse off than someone who has not saved, right? The reason is because if you haven't saved and you want to go to college A, the only way you're going to be able to pay for it is by borrowing. And borrowing is always much more costly than savings. How much more costly? Let's look. Let's say that you save $100,000 and your kid has financial need and gets into a college that meets 100% of need and meets 100% of that need with gift aid. We saw that that's pretty rare, right? But if that were the case, saving $100,000 could potentially cost you about $15,000 over the course of 4 years of college. Okay? If you have to borrow the $100,000, which is always going to be the case if you haven't saved, that's going to cost you $156,000. So borrowing costs 4 times at least as much as saving when you're paying for college. And even if your student is in high school, it's not too late to start saving. So you don't have as much time as if you had started a long time ago, but any dollar saved is a dollar that you don't have to borrow. All right, so let's look at the dates. And these changed a couple of years ago. So if you have, if you know people who sent their kids to college years ago, they're a little different now. But the income year that's being looked at for the FAFSA and the profile is the calendar year that is 2 years prior to the year of college. So again, for someone who's going to start college in the fall of 2020, they're going to look at 2018 as the income year. Assets are valued as of the date that you click submit. Almost all FAFSA and profiles are submitted electronically. So it's the date that you actually click submit. That's the date that assets are valued. So valuation of assets is basically pretty current. The income is a couple of years in the past. So here's a table. And this one shows you for seniors that the first year of college, they're going to be looking at 2018 income. The second year of college, they'll be looking at 2019 income. The third year will be 2020, and the fourth will be 2021. Now, this potentially provides an opportunity if the student is fortunate enough to have grandparents or other relatives who want to help with the cost of college, and the student may qualify for need-based aid, this may provide a strategy for you. So, who's counted in the EFC calculation? Parents and students. Grandparents are not counted in the EFC calculation. However, if grandparents help pay for the bills, the amount of payments that they make counts as untaxed income to the student during the year in which it is made. So if you are fortunate enough to have a family member who's going to help pay for college, who's not included in the EFC calculation, and your student may qualify for need-based aid, if you wait until the end of the final income year that's going to be considered for the aid forms before receiving that money, then it will have no impact on eligibility for need-based aid. And that final year that's going to be looked at on the aid forms, if the student goes to college for 4 consecutive years, is going to be the year that ends when the student is a sophomore in college. So in other words, if grandparents make those payments during the final 2.5 years of college, the final year for income for the financial aid forms will have passed, and it will have no bearing on future need-based aid. Make sense? kind of tricky keeping all those dates together.
Can only start paying on the second year?
So the grandparent can pay anytime, but if the student qualifies for need-based aid, then the grandparent's contributions count as untaxed income for the FAFSA and the profile. So if you wait until after the final income year for the FAFSA and the profile has passed, then that untaxed income won't affect future eligibility for aid. It's only a factor if the student qualifies for need-based aid. If the student isn't going to qualify for need-based aid anyway, then don't worry about when the grandparents help with college. Even if the grandparent, yes, no matter where the grandparent lives, it counts for the student.
You're kind of on your own. No, how much is it because you really check?
So the question is, how can the colleges figure this out, right? Colleges have financial aid staffs whose job it is to figure out how much people are eligible for financial aid. So these people are much more experienced than the average parent is at understanding what's going on. So it is possible, and sometimes people do kind of fly under the radar, but what I'm telling you is the way the rules work, okay? Question here and then there. So the question is, going back to if the grandparents help pay. No, if you have multiple siblings in college, the grandparents' payments only count for the sibling for whom those payments are made. It doesn't affect the younger siblings' EFC. I said siblings' assets count, but we're talking now about payments from grandparents. Yes, so the payments that the grandparents make would be for a child, correct?
That's just two questions. Is cash weighted more heavily or equally to home equity?
So the question is cash weighted equally or more heavily than home equity? In general, all assets are weighted equally, except that business assets are discounted because they're not as liquid. And home equity, in some cases, is discounted, but that varies on a college-by-college basis. So each college makes its own decision about how heavily to weight home equity. But the general rule is that all assets have equal weight, even 529s.
Your older kid?
So the question is about 529s and whether they count in the formulas. 529s have an owner and a beneficiary, okay? Most of the time when people set up 529 accounts, the parent is the owner and the student is the beneficiary. So 529s in which the parents are owners of multiple 529 accounts for multiple children, those all count as parent assets. A 529 account that the student opened, remember we talked about that loophole, that's going to be counted as a parent asset instead of a student asset.
About the 529 and grandparents, it would be smarter to deplete your 529 in the first 2 years, as opposed then the grandparents kick in and say the last 2 years, then they wouldn't have to report that asset.
So the question is, should you use your 529 account during the first 2 years? And I don't want to make a blanket recommendation on that because it can be pretty complicated. But the simplistic theory is that, yes, if you can use other resources during the first couple of years and then use grandparent resources in the final couple of years, and the student is eligible for need-based aid, remember that big caveat, then that could be a good strategy. But you've got to consider multiple factors. Yes.
So once, I'm into the time frame where you're figuring out what year to use, for your child and stuff like that. If you have income that varies and you fill out the FAFSA and the profile, will a school revisit that and say, okay, your income was, down $50,000, now you...
So that's a good question. And this does go back to that special circumstance. If your income varies from year to year, particularly if it's gone down, yes, you can ask the college to revisit that and potentially qualify for more financial aid.
Child is a junior, I'll have a child come in as a freshman. So how is that kind of reflected by the two schools? You're filling out two different FAFSAs and profiles, right, to two different colleges?
So the FAFSA, yes. So the question is having to do with second kids coming along after the first. The FAFSA and the profile are filed from the student's point of view. So the student is filing the FAFSA and the profile technically, even though they're looking at parent information. So really you're going to be involved. But each student has his or her own FAFSA and his or her own profile. Yes?
529 issue, but we were talking about the parents or the grandparents or other family members contributing in the last 2 years, basically, of college. Is that still a factor if the parents have opened their own 529, or the grandparents, I should say, and your aunt and uncle would have a 529 in a sibling or in a child's name?
So the question is whether it makes a difference if the money that grandparents are paying comes from a 529 account or some other type of account. No, it is the same impact.
It's being withdrawn, reached out and taken out of a 529 account. It's still seen as a grandparent payment.
It's still seen as a grandparent payment regardless of the source of the money. Correct, yes. So the question is, home equity lines of credit, do they count as a mortgage or credit card debt? And because they are secured by the home, they count as a mortgage. So they reduce the value of the asset in a profile situation because it's only in the profile that they're looking at home equity. One more question, and then we're going to move on.
Impact of financial aid on early decision. So if you apply early decision, I'm told there's some advantage to that. There's some appeal to admissions officers. And if you're applying financial aid also, what happens if you say, okay, if the college says, okay, you've gotten in early, but we're giving you no aid?
So this is an important question, and the question is about the impact of early decision on financial aid. Early decision is a way that students can apply to college, and what they do is they sign a contract, and the parents sign a contract, and the guidance counselors sign a contract that says that if the student is admitted to that college and the college gives the student enough financial aid to make it affordable, then the student is committed to going to that college. So early decision is often an advantage from an admissions standpoint. The rate of students who are admitted to college out of the early decision pool is often higher than the regular decision pool. But early decision, in my opinion, is almost always a disadvantage from a financial aid standpoint. And here's why. If you apply early decision, you are going to get one financial aid letter from the college that admitted your student. Now, you do have the option of saying, I'm sorry, you didn't give me enough financial aid, so I'm not going to live up to my commitment. But that is a huge bummer for the student, because the student is really hoping to get into this college. And so before you apply early decision, you want to know whether you can afford it or not. The reason it's a disadvantage from a financial aid standpoint is because when you apply regular decision, the chances are that your student is going to be accepted at more than one school, and your student is going to get financial aid offers from more than one school. So you're going to have the opportunity to compare them. And in some cases, you can use those awards and go back to one of the colleges and say, can you reevaluate my financial aid because I think you might have overlooked something. This college is giving us more. Now, it's not always successful, but it is potentially a way to get more financial aid, or at a minimum, see what your best offer is. So from a financial aid standpoint, the only way that I think it makes sense to apply early decision is if you have gone to the college's reliable net price calculator and discovered that the cost that the college projects is likely to be something that you can afford in year 1 and also year 2, year 3, and year 4. Okay? So that's kind of the early decision scoop. I've got these tables for juniors, sophomores, 9th graders, and we won't go over them. They all just increment by 1. So when should you file the FAFSA and the profile? They become available every year on October 1st, and you're going to hear the general rule of thumb is apply early, apply early, apply early. Well, applying early is a good idea in general, but October 1 is not the deadline, it's when it becomes available. And you may want to think about when the best time is to file. So for example, if you make estimated tax payments, then you might want to wait and file your FAFSA after you make the estimated tax payment, because then it's no longer in your account. It's not going to be included in the assets that go into that EFC calculation. If your student does apply early decision or probably early action, then I would recommend that you file the FAFSA and the profile at about the same time that your student files their admissions applications. Be sure to check with every college that your student is applying to make sure you understand the deadlines. We talked about filing when the asset value is low. One thing to keep in mind is that colleges don't receive the FAFSA and the profile information unless you tell them, unless you say on the form, I want this college to get our FAFSA and profile information. So if your student adds more colleges to his or her list after you've filed the FAFSA, be sure to go back and add those colleges to the list to make sure they get it. Super easy to do, but just don't forget.
When they get the application, they just don't ask for it?
I'm sorry, I don't understand. Say again the question.
Sends the information to the college. Does it happen the moment you push the button, or
So the question is, when will the colleges receive the information? If you list a college on the FAFSA or the profile, then they process the FAFSA in batches. So it may not be the same interval of time every time, but generally within 1 week or a week and a half, all of the colleges that were on the list will have received that information.
Students who are not citizen as well as green card holder?
So the question is the FAFSA available for non-citizens? So that's a good question. Generally, financial aid and the FAFSA is available for U.S. citizens and green card holders and a few other categories of non-citizens, but you need to double check to make sure that you understand the status of your student to see whether they're eligible for financial aid and whether filing the FAFSA makes sense. You can check on the FAFSA website, fafsa.gov. Okay, so you guys are now experts on need-based aid. Congratulations. Now we're going to talk about merit-based aid. And again, need-based aid is important to understand, but I don't want to belabor it because a lot of the things that we've been talking about have been assuming that you're going to qualify for need-based aid. And you may or may not qualify, and even if you do, it may or may not be enough to make college affordable. So merit-based aid may be another way to find affordable colleges. To understand merit-based aid, you have to understand a little bit about the business of college. So when people talk about colleges, they usually focus on the admittance rate. This is the percent of students who apply to a college who are then offered admission to come to the college in the next year. Well, colleges, of course, do focus on that, but they also pay attention to another figure, which is called the yield rate. And the yield rate is the percent of students who were offered admission to a college in the spring and who end up enrolling at the college in the fall. And you can see that at Harvard, 5% of the students are admitted. Of those, 84% of them end up going. Harvard has no trouble filling their classes, right? At BU, 22% of the students are admitted and 25% of them end up enrolling. BU has a little bit harder time filling their classes. And at Ohio Wesleyan and Susquehanna, about 70% of the students are admitted and about 15% of them end up enrolling. Now, when that yield rate gets into the 20s and lower, colleges really have to work hard and they really sweat to fill up their seats. They need to have students coming to their college and paying tuition in order to pay all of the bills that the college has. So what do? They discount their price with financial aid in order to encourage students to come. It's just like when you've got a car dealer who's got 2018 cars and 2019 are coming out, they put them on sale so they can move them out. Well, colleges have X number of places that they need to fill, and if they're having a hard time filling them, they put them on sale, okay? And so this final column is the percent of students who attend that college who receive gift aid that is paid for by the college, okay? That's the percent receiving institutional aid. And you can see that at Harvard, 55% receive Harvard-funded aid, 45% are paying the full cost to go to Harvard. But at Muhlenberg, Ohio Wesleyan, Susquehanna, 90% up to 100% of students are receiving gift aid from those colleges. This is a case where you don't want to be in the 1%, right? You want to be in the group that's getting that gift aid. So here's the rule of thumb. If a college has a relatively high admit rate and a relatively low yield rate and a relatively high percent of students receiving institutional aid, that is a college where you might get merit aid. And that means that if you have looked at your EFC and you've decided that 4 times your EFC plus $40,000 is more than you want to pay for college, maybe you look at colleges that offer merit aid. So we'll talk about how to identify your student's profile and how to find colleges that award merit aid. So we said that merit aid is usually called scholarships. It's most commonly based on things like grades, test scores, and class ranks. Does New Canaan report class rank? So New Canaan is like a lot of schools that doesn't report class rank. That's no problem. Colleges know how to deal with it. They'll look at grades and test scores instead. Merit aid is most common at private colleges, but a lot of public colleges now are using it as well. And here's a key point. The highest merit awards go to the strongest students relative to the other applicants to that college. So what that means is that what you might think of as your safety schools for admission may also be your safety schools for financial aid, okay? And as with need-based aid, you need to understand what the college's awarding policy is. Some colleges award no merit aid. Some colleges use a lot of merit aid. So if you need merit aid and you're knocking on the door of a college that doesn't use merit aid, you're not going to get a discount. And first-year students typically get better merit award than transfer students. So keep that in mind. This is a new slide. I'm going to see if you guys like it as much as I do. So we're going to look at some merit at 3 different colleges: Gettysburg, University of Tampa, and Eckerd. And these are the admit rates. The yield rates are in the 20s and lower. Their costs. And then at the bottom, the percent of students receiving college-funded aid. Well, here are their typical merit awards. So at Gettysburg, they award $26,000 in merit aid to students who have a 1450 combined SAT and a 3.8 GPA. At Eckerd, $21,000 of merit aid to students who have a 1310 SAT and a 3.8 GPA. And then you can see that there are some lower ranges of merit awards too, right? For students who have maybe not as strong test grades and test scores and grades. Well, watch what happens when I layer in the 75th and 25th percentile of students at these schools. The 75th percentile means that 25% of the students at Gettysburg scored higher than 1420 on their SAT. At Eckerd, 25% of the students scored higher than 1280 on their SAT. And look, those higher merit awards happen to be pretty close, a little above the 75th percentile. And those lower awards tend to correspond pretty closely to the 25th percentile. I'm not telling if you guys like this as much as I do. But so here is a generalization that you can make. If a college uses merit aid, the best chances for the best awards are when the student is in the upper 25th or in the 75th percentile. If a college uses merit aid, the awards may phase out when you get to about the 25th percentile, but at colleges that compete aggressively for students, just about everyone who goes to that college may be eligible for merit aid. So that's where we saw those 199%. Yes?
For freshman year, or does that continue through the 4 years of college?
So this is a good question. The question is, if a student is awarded merit aid, is that just based on their high school record, and does it continue through college? The answer is yes. It's typically just based on their high school record. And whether it continues through college is a really important point, because at most colleges it does, but at a few colleges it does not. They award a higher merit award to incoming first-year students and then pull it back. So you always want to understand, whenever you get any type of financial aid, what are the terms for renewing it in future years. For need-based aid, typically you renew it by continuing to file the FAFSA and the profile and having income and assets that remain pretty consistent over time. For merit-based aid, typically it's renewable for 4 years as long as the student maintains a GPA in college that the college sets. Now, you want to understand what the GPA is and is it reasonable. Most colleges, I would say, do keep merit aid renewable under reasonable terms. So that might be maintaining a 2.8 or a 3.0 or a 3.2 GPA. But I've seen some colleges where you have to maintain a 3.6 or a 3.7. That's not great, because college is a lot harder than high school. And it's not uncommon for students to dip, especially during their first year. So you don't want to jeopardize that merit aid. Most of the time, colleges will tell you either in their letter or on their website what the terms for renewing aid are. And if they don't tell you, be sure you find out. All right, so which colleges award merit aid? This is the website that you can go to find that percent of students receiving institutional aid. It's called College Navigator. It's got all kinds of data, and this is where you find that Gettysburg awards college-funded aid to 82% of students. Washington College in Maryland awards it to 96% of students. Now, when that institutional aid percent is above 60 to 65%, there's a pretty good chance that the college uses at least some merit aid. When it is over 80%, there is a really, really high likelihood that the college uses merit aid. So if need-based aid isn't going to be the answer for you, merit aid might be another place to look. So, what specific colleges might award merit aid? What I want to do is I want to look at a student who's got an 1150 SAT and find a few colleges where that student might get some strong merit aid, okay? So what I'm going to look for are colleges where that 75th percentile is under or close to 1150 for the SAT. So Shenandoah College in Virginia, their 75th percentile is 1123. That 1150 is above the 75th percentile, so that student is likely to get a strong merit award at Shenandoah. And then Suffolk and Boston, UMass Dartmouth, you're also above that 75th percentile. Well, you don't necessarily have to be above it. You might be close to it, but a little bit below and still get a decent merit award. So at the University of Maine, that 75th percentile is 1210, and there's a good chance that you might get merit there. It's a plug for my home state. Or at Pace in New York, or at Lesley in Boston. Okay, so this is one way to sort of think about what colleges might be candidates to award your student with merit aid given where your student is academically. All right, so this is a summary of the way different colleges award financial aid. And I'm breaking it down into what I call elite and near elite colleges, mid-market, and other. Kind of the shortcut is the elite and the near elite colleges are probably the ones that you've heard of. And the mid-market and others may be the ones that you haven't heard of as much. And the elite and the near elite colleges award a lot of need-based aid. It's common that they meet full need as they define it, and they meet a substantial portion of that with gift aid. On the other hand, they award very little or no merit aid, okay? On the mid-market and other colleges, it says that they gap on their need-based aid. What that means is that there's a gap between what a student's financial need is and the amount of need-based aid that's awarded. They are not meeting full need typically, but they tend to use a lot of merit aid. So if you find that need-based aid isn't going to be the answer to your college payment question, merit aid may be available. It turns out that there are maybe 100 colleges in that elite and near elite category, and there are over 2,000 colleges in the other categories. What that means is that there are a ton of colleges who would love to have your student apply there, and they might reward your student with merit aid awards, right? Okay, so now you're an expert on need-based aid, you're experts on merit-based aid, congratulations. Now let's talk about how you identify your particular cost for a college, because that's what you really care about. And the way to do that is to use what's called a net price calculator. So net price calculators are required by law. Every college is required to have one. And a net price calculator is going to give you an estimate of what that starting sticker price is, what the gift aid is. It's going to do the arithmetic for you and show you what the net price is. Now, all colleges are required to have net price calculators, but they are not required to have good ones. And here's how you can tell the difference. If it is super easy to use, it asks 4 or 5 questions, you finish it in 10 or 12 seconds, it stinks. If it asks a lot of questions, if it drives you crazy, if you have to look stuff up, it might take 20 minutes, then it's probably asking enough questions to get enough information to give you a reliable estimate. And don't be discouraged, because the first time it might take you 20 minutes, but they're going to ask the same types of questions over and over. And so you get much faster at it as you go along. When I do net price calculators, I find that they are often within a few $1,000s of what the student actually gets offered. So that's pretty good when you're talking about a starting cost of $60,000 or $70,000. Okay? So the question is, do they try to do both merit and need-based aid? Not necessarily. So colleges that don't award merit aid aren't going to have merit questions on there. And some colleges that do use merit aid but don't use it all that much don't have merit questions on there either. But a lot of them do include questions: what's your grade point average, what's your test scores, that kind of thing. And they will give you estimates of potential merit aid.
I'm getting mixed up on the terminology. So gift aid in this formula, is that merit aid only, or is that something different than merit aid?
Yeah, that's a good question, okay? So the question is, gift aid, is that merit aid only? No. Gift aid is free money. It's money you don't have to pay back, and it can be based on need or it can be based on merit. So it could be either. And if they call it scholarships, it's quite often merit-based aid. If they call it grants, it's quite often need-based aid. You'll see on net price calculators, often they'll say, congratulations, you qualify for $8,000 of merit aid scholarships and an additional $2,000 of need-based aid. So, and always remember, cost of attendance minus gift aid equals net price. Net price is what you always want to focus on. All right, so I'm a numbers guy, and I don't find this net price calculator output all that friendly. But if you don't, just remember cost of attendance minus gift aid equals net price, okay? So you can always zero in on what you really need to find, all right? So tuition and fees, room and board, books and supplies, transportation and other expenses, all of those add up to the cost of attendance minus the gift aid equals the net price. So don't get flummoxed by a lot of information that kind of seems overwhelming. Just zero in on those key things that you need to find: cost of attendance, gift aid, and net price, right? So there's one final myth I want to talk about, which is the NPC myth. And a lot of people think they can't use a net price calculator until they've filed their taxes or their FAFSA. That's not true. You can use it at any time. And what you will find is that the earlier you use it, you may not have perfect, complete information, so your estimate might be off. But as you get closer and closer to the student graduating from high school, those estimates are likely to get better and better. So you can use an NPC anytime. If you become a net price calculator nerd like me, you can develop these kind of charts for just about any school. And what this does is it shows across the top different merit profiles. and it shows across the side different need profiles. So what I want to do is show you how to use net price calculators to compare college costs. And I'm going to use an example of a B- student with an 1100 SAT and a 15,000 EFC. And at Shenandoah University in Virginia, this student is likely to get a merit award of $7,500, need-based aid award in addition to that of $4,700 for a net price of $35,000. Okay? So what you do is you go to the net price calculators of different colleges and you compare them. This is where I want to stop myself and remind you that net price is an important part of the picture, but the object is not necessarily to find the cheapest college you can. It's nice if you do, but the object is to find a college that's going to be suitable for your student, to offer your student what they want in terms of a major and learning environment and that kind of thing. And in addition, is going to be something that can be affordable for you guys as parents and for the student at the end of 4 years, okay? So let's look at that B- student with the 1100 SAT. And when I do net price calculators at different schools, the net price at Roger Williams is $41,000. At Shenandoah, we just looked at that, it was $35,000. West Virginia University is $31,000. So that's kind of interesting. The out-of-state cost for someone to go to West Virginia University is about the same as the in-state cost to go to UConn. Kind of interesting, huh? I think so anyway. At Wheaton in Massachusetts, that student's net price is $23,000. At Bowdoin, it's $18,000. And at UConn Stanford, living at home and commuting, it's about $16,000. Now, I know that commuting to UConn Stanford is not the same as going away to college and living in the dorm. But I put that up there to remind people that there is an affordable path to college for everyone, right? It may not be the path that you expect necessarily, but there is an affordable path to college for everyone. So out of these schools, going away and living in the dorm, Bowdoin looks like the best bet. But unfortunately, the B- student probably isn't going to get into Bowdoin. So that's why that one is grayed out. The dark green means that it's quite likely the student will be admitted. The lighter green means it's kind of probable, but not necessarily a sure thing. And gray means probably not. So you want to be thinking about those types of questions as well when you're figuring out your net prices. So we're almost done, and we'll finish up on time. We've got one last thing to talk about, which is how do you pay the net price once you've figured it out, okay? So I'm going to tell you the 3 ways you pay the net price. It is from income that you have earned over time. There's prior income, money that you earned in the past and saved. There's current income, money that you earned during the college years and use for college expenses. And there's future income, money that you earn in the future and use to repay loans. Those are the 3 ways to pay for the net price, okay? So is the net price affordable? Remember that award letter we looked at the beginning of the evening. The net price was $35,000. So I want to think about that and decide if that's going to be affordable. Well, we've got to remember that college is going to be for 4 years, right? So there are a few questions we need to ask. One of them is what's going to happen to the cost of college over time? And is the aid going to be renewable and on what terms, right? We talked about making sure you understand the renewable aspect of aid. So for this example, I'm going to assume that the cost will increase 2% a year, that the aid is renewable and constant over 4 years, and that the student has $2,000 in savings and the parents have $25,000 in savings. So let's see how we're going to pay for this college. At that 2% per year inflation, that $35,000 a year college is going to cost $145,000 for a 4-year degree. So let's pay for it. I'm going to look to the student first. So the student can get a work-study job and earn about $1,800 a year at this college and use that for college expenses. That's current income from the student. And I'm going to say that the student is going to use federal student loans. If you have to borrow for college, federal student loans are always the first place that you should go because they're automatically available, the interest rate is reasonable, and there are protections for the borrower if the student runs into trouble after college. But there's a limit to how much you can borrow. And for 4 years of college, the maximum most students can borrow under the federal student loan program is $27,000. Okay? So that pays for a chunk of college. Let's also use the student's $2,000 in savings. We said that student assets count more than parent assets in the aid formulas. So let's use that first if we have to use some savings, and maybe there might be a little bit of additional need-based aid in the future. We don't know, but at least it sets you up for that in the future. After that, I'm going to assume that the student is going to get a summer job each year before college. If they work at $10 an hour for 40 hours a week for 10 weeks in the summer, they earn $4,000. They pay taxes, they go to the beach a couple of times, and they should still be able to bank $2,000 for college, okay? After this, the parents are going to look at their budget, and they're going to decide that they can pay about $375 a month for college expenses out of their ongoing income. So that's $4,500 a year. After this, we're going to look at savings. And we're going to use $19,000 of savings, and that fully pays for year 1 of college. So that's good news. But we still have years 2, 3, and 4. So in year 2, we're going to use the rest of the savings, and then we're going to have to borrow. We're going to have to borrow an additional $15,000 in year 2, $21,000 in year 3, and $22,000 in year 4. This is generally going to be a parent responsibility. Even if you say that it's a student loan, a bank is going to look at the student. 18 years old, no job, won't have one for 4 years, no collateral. They're going to look for a cosigner, and that's probably going to be the parents. So always think of this additional borrowing beyond the $27,000 in federal student loans as a parent responsibility. But the good news is that we have fully paid for 4 years of this college using prior income, current income, and future income. We end up with $27,000 in student debt and $58,000 in parent debt. Is that a good idea? Well, we don't know yet. And there are a few questions that we need to answer in order to decide. The first one is, what will the loans cost? Student loans carry an interest rate of 4.5%. Parent loans carry 7% under the Federal Plus program. This is the maximum you should have to pay. Connecticut actually offers Connecticut residents a better rate. So if you can get a lower rate than the 7%, get it. But this is kind of the worst case scenario. And you pay back student loans over 10 years. So for every $1,000 of student debt, the student is going to have to pay $10.38 a month for 10 years. That equals $125 per year. The parent debt is more expensive. It's a higher interest rate, so that's $140 per thousand per year for 10 years. So the $27,000 in student debt, 27 times 125 is $33.63. The $58,000 in parent debt, 58 times 140 is $81.10 per year for the parent debt. They start, do they start right away? They start 6 months after graduation in general. In most cases. The Connecticut loans I told you about, I believe those might start right away. So generally, yes. There are some exceptions to whether they accrue interest during all of the time.
Parent didn't have the money at the time they took the loans. If they then had accumulated the money by the time that the loan was falling due, is there a penalty if you paid it off?
So the question is there a prepayment penalty if you pay the loan off early? No. You will have to pay the fees and the accumulated interest, but there is no other prepayment penalty. So that's good news.
The parent loan is $58,000.
Yes.
10-year loan?
Correct.
So 8,000, call it, times 10, 80,000, 81,000. So you're paying basically $30,000, $25,000 interest.
Right. So this man has done the math. You do $8,100 a year times 10 years. That's $81,000. So you're paying $23,000 in interest plus $58,000 in principal. So the other question is, now that we know how much it costs, is it a good idea? And to decide whether it's a good idea, for the student, you need to understand, or you need to be able to guess how much the student is going to earn after college. My rule of thumb is that payments for education debt should not exceed about 10% of your income. So for the student who borrowed let's say $3,400, or who has to pay $3,400 per year, if the student can get a job that pays $34,000 a year, then the student's debt burden will be less than 10% of his income. He'll have 90% of his or her income for gas, groceries, good times, rent, everything else, okay? For the parents, it is more difficult to figure out because the parents have other obligations, perhaps. They may have other children who are going to go to college, and they've got to think about their retirement. And in this example, I see a big red flag for the parents. Here's what it is. When we were looking at how they were going to pay for college, they said they could afford $375 a month or $4,500 a year out of their income during college. Well, what makes them think all of a sudden after college they can go from $4,500 to $8,100 to pay off that debt? That doesn't look like a good idea to me. Okay? So this is how you look at some of those big numbers and bring them back to reality to decide if it makes sense or not. So the question is the debt undergrad only? Yes. Everything we've been talking about is just for the 4 years of college. Oh, I'm sorry. The limitation of the $27,000 is just for undergraduate. Students can borrow more than that for graduate school. There are other limitations. I don't remember them offhand. They're pretty generous in allowing you to borrow more, and that's where a lot of the student debt problems come from, is from kids who graduate for who borrow for graduate school. So we're almost done. Yeah, good idea. So we'll hold the rest of the questions, and then I'll stick around for a few minutes afterwards. So what I recommend doing is looking at those net prices, as we talked about for 1 year, extend them out for 4 years, and then decide what's your zone of affordability. And when I'm working with families, what I try to do is look at what's the parent debt-free point. To me, that's usually an affordable point for parents. They may decide they can afford a little bit more in debt, but that's kind of a good rule of thumb as a way to start. And then these are the types of considerations you should keep in mind when you're thinking about what makes up your zone of affordability. So that zone of affordability is going to be different for everyone, for every student. People always say, my kid is going to apply for all kinds of scholarships and we're going to help use that to help pay for college. Well, it's a good idea to do that, but keep in mind that the vast majority of scholarships to pay for college come from the colleges themselves in the form of the need and merit-based aid that we've been talking about tonight. So it makes sense to apply for these, but it's usually going to be maybe $500, $1,000, $2,000. Better in your pocket than someone else's, but it's probably not going to solve the big picture problem. So, how does everyone else pay? Everyone else pays the same way we've been talking about tonight. Prior income, current income, and future income from the parents and the students. So, students can automatically pay for $43,000. That's work study, summer job, plus that $27,000 in student loans. If you want to try to pay more than $43,000 for college, you need to find a combination of either a lower net price that gets it closer to $30,000. That means either a lower starting price or more gift aid or a combination of those two. Or you need to have either more savings or more current income used to pay for college expenses or more debt. So when everyone else is talking about how they're paying for college, it's exactly the same as the way we've talked about tonight, okay? So let's keep it all in perspective. I like to talk about the stages of grief when you're thinking about college costs. I find that parents can get through the stages of grief pretty quickly when they start seeing those debt numbers. Kids, it's sometimes harder, right? So it's a good idea to be sure to be talking with your students about affordability questions before they apply to college. So if your student is a senior, start talking to them now, because what you don't want is for them to be accepted to a bunch of colleges in April, and then you have to have that hard conversation with them. Sorry, we can't do this. Another thing to keep in mind, college is important, but it's not the goal. The goal is to set your students up for success after college, right? So you don't want to blow the budget on 4 years of college and then be paying the price for 45 or 50 years after college. These people were pretty successful. The guy who founded Starbucks went to Northern Michigan University. The head of Walt Disney went to Ithaca College. And the CEO of Hershey went to Shippensburg University. What do those have in common? They are not the big name colleges that everyone thinks about. And another way to keep it in mind is to look at what people earn after college. So at Colby, American, and Clark, the difference between what people earn, what graduates earn in their middle career years, age 35 to 45, is about $1,900. It's very close, but the difference in the 4-year net price is over $58,000. So finding financial safeties is maybe a matter of using the numbers like we've done tonight. You can go through this process to identify your student's profile, look for colleges that are going to be suitable given that profile. Or you can seed your list with different types of colleges that have different awarding strategies. So always include an in-state public college, maybe an out-of-state public flagship. We saw West Virginia University was relatively affordable. Maybe a secondary public college like Keene State. If your student has full need, those highly selective colleges are likely to meet a big portion of the need. If you need merit aid, there's a book called Colleges That Change Lives, and there's their website. And those colleges, there's about 40 colleges on the list, and 30 of them use a lot of merit aid. I'm not going to go over this, but if you Google this site for federal tax considerations, there's a lot of benefits that you potentially can take advantage of. And there are some in-state Connecticut benefits We talked about the loans that have a better interest rate than the plus loans. And then there's a 529 plan with some benefits. So that's it. Thanks a lot for coming and sticking with it. And I'll stick around for a few questions. Yes.